Hi, Larry Gaines, PowerCycleTrading.com. In this video, I'm going to show you how you can kind of leverage high volatility markets. So when you think of leverage, you think, wow, maybe getting out of control, too much risk versus the potential reward. But there are ways to use leverage and also keep your risk very, very under control. So in this video, I'll show you an example. So this is MasterCard, and it's got a really nice, chart pattern. I mean, the broad markets have been coming down very volatile, up and down, and lately kind of been pulling back. So any long trade setups that I'm looking at, I want to have it very defined, controlled risk with still potential to have a big payoff or a big reward. So this chart pattern looks pretty good. We're back over this 618 retracement area, which is a key move, not a key moving average, but a key Fibonacci level. We're back up above these key moving averages. So here's the 50 simple moving average, and here's the 8 and the 21. So we just also had I like this what we call a 15 crossing the 13 moving average signal. So a lot of times we get really nice powerful momentum off of that. So this trade is a butterfly, but not just a regular balanced butterfly, but a broken wing butterfly on MasterCard, and we're looking for a potential target up here to about 280, 2.5, 283 in this area here, and we're thinking that it could just kind of be a slow grind up. So one way to do this and keep your risk or your potential at risk very low is to do either a butterfly, a broken wing butterfly, or a ratio butterfly, or you could do a broken wing ratio butterfly. So let me show you the broken wing butterfly and how that can really pay off for you. So if you break down this trade, this is we were looking at this is in the trade room today at Power Cycle Trading. We did this broken wing butterfly. So basically what it is, it's like the 23 August series, which is expiration this Friday. So we're looking for a move to potentially that 282 level. So the makeup of this trade is basically a call debit spread, the 280, 282.5, and that was set up going in at 96 cents. And then if you did a balanced butterfly, you'd be selling the 282.5, 285 bear call credit spread. At that point in time, that was $50. Okay, so your butterfly, you would be in for this with a $46 at risk. But by skipping a strike, instead of doing the 282.5, 285, you do the 282.5, 287. Skipping that strike, you get a bigger credit. You can see you get a credit of over 80 cents versus 50. So $30 better. So in this situation, our downside risk then is only $15 versus over 40 if you did a standard butterfly. Now the potential profit's even bigger too, because you brought in a bigger credit. So if this was to go out on Friday around 282.5, our target, this will be up over $200, about $225, versus the balanced butterfly would be up around $200, actually a little bit less than that. So it's a really great strategy. And then the other thing we can do is, if the market started to fall over, we could also convert this into a broken wing ratio butterfly by selling another 282.5, 287 bear call credit spread against it. So that currently going out today, if we wanted to do that into the close today, we could have sold that at the 282.5, 287 at a $50 credit, brought that in, and now there's zero risk to the downside. We've actually turned this into a credit spread on the downside, and still have potential for a big profit over 270 if it goes out at 282.5. So that's the beauty of options. There's just so many things you can do once you understand the fundamentals of options, the vertical spreads. So hope you enjoyed this video, and I'll talk to you on my next video update.